Welcome everybody to the Tuesday edition of the Not Your Average Investor Show. Today, we're talking about 1031 exchanges with Claudia Kiernan, the Senior VP of IPX Exchange. And we're going to talk about what a 1031 exchange is, how it can save you tens of thousands of dollars in taxes, why investors in California, New York, and other high-priced real estate markets use 1031 exchanges to diversify real estate portfolios and increase their rates of returns, and the do's and don'ts for executing on a 1031 exchange. We are all in for a treat right now because we are officially live on Facebook. It is Tuesday. It is the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, the man I like to have by my side, the man that we call GC because he's got genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his parents named him Greg Cohen. Say hello, Greg.
It's so convenient they named me Greg Cohen, because I think you'd be calling me GC even if they didn't name me Greg Cohen, right?
That's a good call, GC. Also a GC. Good call. And with us today, the star of the show is Claudia Kiernan of the Senior VP of IPX Exchange. A company that has done over 24,000 1031 exchanges and en route to 40,000. We just found out. She lives in St. Augustine, Florida. She's been doing this for 15 years. She's a real estate investor herself, and she is here to share her knowledge with us today. Claudia, welcome to the show.
Oh, thank you for having me here. This is wonderful. Yeah.
It's a pleasure to have you here with us. It is a pleasure to have our Not Your Average Investor Show family with us here today. We like to say that if you want to know about owning rental income properties, you're in the right place. If you want to know about the best property management practices for rental property investors, you're in the right place. If you want to get an edge in the Jacksonville market, and as a real estate professional, that may lead to some opportunities for you and your clients, you're in the right place. Next place to go is chatwithjwb.com. And the next thing that we're going to do right now, Claudia, are you ready for our roll call right now? This is a little tradition we started. All right, here comes the roll call. John Hannon, good afternoon. Lee Bishop, good afternoon. Lydia Filzen, howdy to you, Lydia. Denny Davies, he's in the house talking about 1031s. Drew Barnhill from Atlanta, he's here. Good day, everybody. Carl Thompson is here. Good morning, everybody. Leo from California, he's here. Good morning to you, Leo. Jen Filzen, our official ambassador of JWB Meetups, who made these amazing shirts and is out there like just Johnny Appleseed of the Not Your Average Investor shows in the house. Jenny, good to have you. Jen Filzen. Shelly Johnson from Bradenton, that we affectionately call B-Town around here. Nadeem Shah, dialing in from the West Coast. Good morning to you, Nadeem. Who else we got? Zach Correa. We got Zach Correa in the house. Aloha, Zach. Who else is here? All right. I think we got the full roll call. Good to have everybody with us. Good to have you here on a Tuesday to get to pick Claudia's brain. Claudia, just get started, right? You're a real estate investor yourself, but you started off as an attorney, right? What got you into 1031 exchanges?
Yeah, absolutely. When I went to law school, I didn't even know really what I was going to do with my law degree. In fact, actually, I was an anthropologist before I went to law school. Went to law school at 29 and then got out and I love real estate. So when I was still in New York, I did some real estate closings and I got exposed through my clients to 1031 exchange. And the fascinating thing I realized right off the bat was that my clients that were doing 1031 exchanges versus ones that weren't were growing their real estate portfolio so much faster. Anyway, make a long story short, I love Florida. I have family down here in the St. Augustine area, and I started working for a qualified intermediary full time in 2005. So just love what I do, and I love helping people save taxes and grow their wealth and real estate portfolio.
Awesome. And you've been working closely with JWB now for a while, right? Like you were just talking about their fancy old office that they used to have and that relationship. How did you get to know Greg and Alex and these guys?
I don't recall exactly how it happened, who contacted who. Might have been me even, because, these guys are doing such great things here. So I probably just did the old knock on the door and say, hey, let me be a resource to you guys. And that's how it started. And then what's happened over the years is, what they provide is the perfect solution for our clients because, a lot of them are looking for investments where they can get a great return on their money and maybe not have to manage the property so much. So.
And it has been such a wonderful partnership working with you. And for us, this 1031, what this can do for investors, and I can't wait for us to talk a little bit more about this today. This is one of those wealth creation strategies, those tax deferral strategies. And everybody on the show and the Not Your Average Show community, they know that I love tax savings, right? That gets me going. So like this is going to be really incredible. But for all of the wonderful things that a 1031 can do for you, you have to absolutely get it right. You get one chance to get it right. So you've got to be working with a team that knows exactly how to dot the I's and cross the T's, because, I have heard horror stories of other investors out there who did not work with qualified intermediaries who lost opportunities to save literally tens and sometimes hundreds of thousands of dollars by not doing it the right way. So I'm so glad to share you with the audience here and your expertise, because this is something that it's a tool that can be used for great things, but if you don't know exactly how to use it, it can really hurt you.
Yeah. I mean, in fact, we get calls here. So I'm in St. Augustine is our Southeast regional office. I work for IPX 1031. It's a nationwide qualified intermediary. So here in the office, we get calls, unfortunately, too often where someone will say, hey, Claudia, want to do a 1031 exchange. And I'll ask them, well, when is your closing? And then they say, oh, my closing was last week, right? And it's too late because there's so many misconceptions out there on how a 1031 works. They think, oh, they know some of the rules, like, okay, I got to identify 45, close at 180, but they don't realize, oh my gosh, I gotta set this up beforehand. So I think part of the reason they have me on here today is that, we're a resource because we can always, answer the phone. And if you're not sure about something, we'll guide you and make sure you don't miss a step.
Yeah, it's just wonderful working with folks that uphold that standard that we're trying to create. We're trying to create this peace of mind experience for investors that's been lacking in rental property investing. And you want to talk about something that can be nerve-wracking, understanding the ins and outs of a 1031. When we get to work with somebody like Claudia, and we have the opportunity to learn from her today, we get excited about sharing our reputation with Claudia because she does such a wonderful job. And for everybody on the show today, this is a great chance to ask those questions that you may have. So feel free to fire those questions in early and often. And I know Claudia is going to be a great resource for you guys.
That's right. This is an interactive show. I want to welcome Marilyn Cotterman from Homosassa, Florida. She just dialed in here.
She is from the home of the manatees. Did you know that, Pablo?
I did know that Homosassa is the home of the manatees. We got Chris here from the Hudson Valley as well. Good to have you, Chris. And for anybody that's new to the show, this is an interactive show. Using the chat is wonderful. We want y'all talking to each other and sharing experiences. Using the Q&A really, really helps me ask Claudia or ask JC any kind of questions you have. So really use those. If you want everybody to see what you're writing in the chat, you got to change that box on top to everyone so everybody can see it and you can all interact. And something that's happening in the chat, something that you've referred to already, is the trickiness of a 1031 exchange and how specific it has to be. And as someone that has a friend that isn't very well versed with 1031 exchanges, I would love to be able to explain to my friend who really has no idea how it all works. So Claudia, if you could kind of, asking for a friend here, give us a rundown of, what
Sure.
you need to know in order to execute a 1031 exchange.
Absolutely. So for your friend, the 1031, by the way, it's been part of the code for 100 years this year. So it's been around a long time, but what it really is, and if we just look at it simply, it allows what the IRS always refers to as a taxpayer. That's all of us, right? Taxpayers. It allows someone to sell a property either held for investment or business use a qualified intermediary, and reinvest into another property held for investment or business use. So of course you have to have a qualified intermediary. That's what we do. And our role really is to hold the proceeds, cannot receive those funds at the closing of the sale, right? Otherwise you're recognizing the gain and you're going to pay tax. The other thing that we're doing is we're creating the exchange of properties. So what's really one of the biggest misconceptions is that a lot of times, because of the way the code section's written, it says, well, the property you sell, the property you buy must be like kind. So a lot of times people think, hey, I'm retiring, I'm selling my office condo, and now I got to go out and buy another commercial property. That's not the case, right? all real estate is like kind to all real estate. So one of the scenarios we see is someone selling a commercial property and getting into a single family rental home or diversifying. That's a big one, right? They're selling their commercial property, maybe even out in California or in New York or wherever, and they buy multiple replacement properties. And a lot of times they're diversifying, getting a better return on investment. So again, it is a tax deferral strategy. It's referred to as either a 1031 exchange, a tax deferred exchange. Sometimes you'll hear, especially if you're out in the West Coast, it referred to as a stalker exchange, but they're all the same, right? And again, it's kind of like, for lack of a better analogy, like a rollover. You're reinvesting into more real estate.
And Claudia, if would you help me just kind of give a really kind of tangible example of how this can help somebody build wealth, right? Like in tax deferral strategies, the goal here is not just to pay less taxes, but to be able to use that income that you would have had to pay Uncle Sam to make additional investments and then continue to have them grow and grow and compound, right? So let's just say that somebody is in California, and out in California, let's just say with the federal income tax and the state income tax, you're paying 50% in taxes. All right. And then they sell a property that they have in California and they made a $200,000 gain on that property. If they sell that property, right, that would mean that if they didn't work with somebody like yourself and didn't plan to have a 1031 exchange, at the end of the year, they'd have to pay, you know, if they let's just keep it simple and say they sold it really quickly, they'd have to pay 50% in taxes.
Right.
All right. If they held on to it for a longer period of time, maybe it's less, but let's just keep that example, right? They'd have to give back $100,000. But now with the 1031, and could you pick it up from here and tell them what they would be able to do?
So yeah, here's the power in it. So in that example, if 100,000 is going to the IRS to never earn another penny for us, right? So instead, we get to keep all of the proceeds from that sale and use it to go out and buy more real estate. And if you think about it, that's just one transaction. Most of our exchangers we're working throughout the years with. And then if we have that money that was instead would have gone to the IRS to go out and use and buy more real estate, that, like Greg is saying, it gives us a better return on investment, right? Because we have more money to put down on that property, or we can diversify and grow our real estate portfolio. Big strategy, right? They're either selling a property, let's say for $1 million, and a lot of our sellers have very low basis, right, on the property, or the other side of that is a lot of gain. So they get to then, let's say, go out and buy 4 properties, right, or 5 $200,000 properties, and they keep all of that money, reinvest, and then they're getting a better return on investment on that as well. So powerful.
Yeah, sounds powerful, right? So if I'm breaking this down in my friend's very simplified brain here, you're selling a property that has appreciated, and you're taking that money out, and then the 1031 exchange rules, if you play by them, allow you to use a qualified intermediary. That would be a company like yours, right, Claudia, to kind of quarterback this deal or verify all this stuff that allows you to not pay the taxes that you would normally pay on what you would have gained from appreciation, as long as you are investing into other real estate. And
Right.
therefore, if you're going from a high price market where something appreciated wildly, for example, we had Ken Moline on not that long ago. He's got some stuff close to Silicon Valley area, right? Like that Northern California area. His house has gone up astronomically. He cashed out. He had a ton of equity in there, and he was able to buy 5 properties in Florida with that money before actually paying the taxes and deferring that later on for when it actually becomes, some kind of retirement thing or something that he's actually going to take credit out. That's basically the 1031 advantage, is that you can take that chunk of money that would have been taxed at capital gains and reinvest it into other property, as long as you're playing by the rules, correct?
Absolutely. Yeah. And if you think about, like someone in California is looking at 4 levels of tax, right? You have long-term capital gains tax, which is 15 or 20%, depending on your taxable income. If you're a high income earner, you're going to be at 20%. Then you have the 3.8% that funds the Affordable Care Act, right? And so then we capture on depreciation. Now in California, you have the highest level of state tax, right? That could be as high as 13.3. So by following all the rules, they would be able to defer all those taxes. That's why you get to that really high number, right?
Mhm.
One of the things too, a lot of times when I talk to clients or I'm teaching a class, many times I get people respond to the class and say, wow, that's some loophole you have there, right? That 1031, but it's not. It is a part of the Internal Revenue Code. It's encouraged. So what it's doing is that if you think about it, if someone sells a property and they're going out and reinvesting in more real estate, they are creating jobs, right? Because people that invest in real estate improve the property, and actually exchangers improve it even more, right? Because they have more money to do so on hand. Plus, if you think about it, also it is investing in a local area, right? Property taxes, all of that. So it's encouraged. It's one of those tools that not only helps all of us in this room that own real estate, right? But it also is one of the biggest economic stimuluses that we have.
Yeah, that makes sense. And we were kind of talking about this yesterday when we were warming up for the show, this idea that it is this economic stimulus, and sometimes it gets maligned and people talk about it a lot, specifically with administration changes. And I feel like that's already present here in the Q&A. So let's just grab the bull by the horns, right? Lee Bishop is asking about knowing that this new administration is thinking about changing tax deferral methods. Do you think this is a smokescreen to scare investors? And you told me you've been around this block a couple of times, right? Like you've
Oh,
seen
yeah.
this before. Why don't you give us a little bit of perspective on that?
Yeah, it's interesting when your career is connected to the Internal Revenue Code. We all say in our world is kind of like we have a target on our back a little bit. This is nothing new. I think it goes all the way back to the Clinton administration, even our last administration. So, whenever they're looking for a pay for, if there's not the knowledge of 1031, it looks like a great way to, okay, how do we pay for, like, for example, in the recent 2022 reconciliation budget resolution, well, how do you pay for all these things? So the last administration was a total repeal. What is proposed now is with a 500,000 cap per individual or per taxpayer in a given year. So, IPX is kind of working very hard with other qualified intermediaries and industry groups to educate Congress and explain how, the 1031 is that economic stimulus. And so we're positive about it, but in terms of it not happening, but we're also worried about it too. So you'll see on our website at ipx1031.com, you'll see there's a big red strip there. If you hit on that, you can send a letter to your congressman, because it is really important that it remains the way that it is, so that, the average exchanger and even exchange is 500,000 or less, but still there's that situation where it could affect a lot of businesses and larger transactions as well.
Yeah, you got to think about it from an economic driver perspective. There's the advantages of the 1031, which continue to encourage long-term investments and additional properties coming online, with the great thing that does for the community, the tax base, all that good stuff. But you got to think, if you're just thinking about the liquidity of money, if I'm sitting in California and I'm sitting on a huge gain and I don't want to pay the taxes on it right now, I'm just going to sit on that property. I'm not going to sell it anymore. So you got to think
Right,
about that across the entire
Correct.
country, right? That stops the liquidity of money, right? And then when money's not changing hands, goods and services aren't being purchased. So you got to think that there's other things that would be less
Negatively
damaging
impacted.
to go down that path,
Right.
if we're trying to find the money to pay for some of the things that we're doing from the government's perspective. But
Absolutely. Like if you think of some of our exchangers that own, a warehouse for their business, and they want to now exchange it into a larger warehouse. Well, maybe they wouldn't do that, right? Because they don't want to pay the tax, so they'll just build. But good point, Greg. Yeah.
That makes a lot of sense. And Claudia, last time around, right? Like real estate, right? We talk about cycles. This is another cycle, right? An administration change affects that type of stuff. Last time around, can you talk about kind of what they threatened and then what ended up happening as far as taking away a 1031 exchange and what ended up going down?
It was part of the, a pay for the Tax Cuts and Job Act. And so it was a total repeal. They did, at that time, they did get rid of and repealed exchanges for person. as a company, we did exchanges not only for real estate, but we did exchanges for like business equipment, like cranes and trucks. And we did exchanges for airplanes and franchises. If you have someone selling a hotel, they may have had the real estate they're doing an exchange on, and then maybe also the franchise. We even had the original exchanges of livestock, right? So that no longer is available to our exchangers. So we only do the real estate at this point. But, what it just took was, like anything, is just educating at that time the Republicans about, what a 1031 is and why it's been around so long, and the many different positive things we've been talking about.
Knowing that you had that perspective, seeing it being challenged before, and then seeing some elements of it being taken away, not real estate, but those other things that you were just talking about. I think of like a worst case scenario. Let's just say that the most recent suggestions of capping it were in place. When could you foresee that first time taking effect and affecting somebody who's listening to the show right now and limiting their ability?
I don't know, not quite sure. Maybe in probably next year, if it did go through. I think that there's some significant timelines in that. There's a committee, I think in September sometime. So we should know.
We'll know in the fall. There will be some period after that. So and from what I'm understanding from you, it's not on the table to totally axe the 1031. What's on the table is to cap it at $500,000.
Right. Right. Of gain, not the sale price. So a married couple would be $1 million, right?
Married couple. Okay. And is that in one calendar year?
Yes, that's my understanding. Yeah.
Okay. Yeah. All right. So that's that's potentially on the table, and that most likely wouldn't be implemented until sometime next year. We know how government works. So it's good to understand what potentially a worst case scenario could be here.
Yeah,
Yes.
it's good to understand that. And you see, I go back to kind of what we talked about during COVID time, right? This idea that real estate is its own asset class in the eyes of the regulators and the eyes of the government and the eyes of the people, in that it's this like necessary thing that really, really drives economy, right? Like really drives multiple levels of our economy. And while, Uncle Sam isn't as passionate about you upgrading to a bigger pig, buddy, sorry. They do care. It does affect on many, many different levels, upgrading housing and or exchanging, like Claudia said, from one warehouse to another. And the way that it all trickles down affects so many sectors of the economy that's really hard to mess with, right?
Yeah.
Yeah, I definitely see your point. I mean, what the point you're making is all through COVID, right? There's a reason why all the stimulus money went to support housing. It's went to support people in their house. And it wasn't just because the government wants people in their home for the people's sake. The government wants people in their homes for the government's sake, for the country's sake, right? It's a critical need. The only thing that I would say that might not be going in our direction here, everything you're saying as far as real estate is absolutely true. But, 1031s are not known by the mass public, right? It is something that is enjoyed by savvy investors. And those things tend to have a bullet on their back, So I don't know. I'm just trying to think about it from the opposite perspective. I think you could say, well, that's a target that could easily be, vilified.
Except, when you do look at our exchangers, they're mostly, people like myself, right? They have, a couple single family rental homes, or they're farmers, so it would really kind of affect a lot of people, but yeah.
Yeah, makes sense. All right. So that is the uncertain future, kind of discussion that I'm glad we got out of the way. Let's we got some great questions in the chat. I would say I would love to kind of like bring this back to just a very simple question of, before selling the property, before the property is sold, what do property owners need to know if they plan on using this super powerful tool?
Yeah. So what they need to know, or the critical time is, when we start setting up the exchange, is when you go under contract, and you need to have that qualified intermediary involved. The earlier the better, right? Because we can go through certain, spot some issues that there might be there, but it's really a relatively simple process in that, we coordinate with the settlement agent, right? They're key. So if you're out on the West Coast, you're referring them to escrow, right? Or escrow agent, or here, the title company on the East Coast. or the law firm. So we'll coordinate with them and we create all the exchange documents. Now, the exchange documents have to be signed on or before the closing of the sale property. When we're qualified intermediaries, what's great is that, we generally all just charge a flat fee, right? And there's no fee for consultations. Even though I'm a licensed attorney, it's not like, you can call us up, we can go through the whole 1031 process with you. And there's no charge, there's no fee at that time. We're on hourly charge fee schedule. So what's nice about that is you can always run something by us, right? So the critical thing is before you close on something, you really definitely want to get in touch with your qualified intermediary.
Yeah, I'll give a little bit of color kind of internally when we try to have our clients or potential clients get involved with Claudia's team. Typically if a client comes to us and they say, hey, I have a property that I'm planning on selling in California, and I'm planning on using that capital to go and purchase 4 JWB properties or whatever the number may be. As soon as possible, we'd like them to get in touch with Claudia, but definitely if they are under contract to sell that property in California, that is like a beeline introduction coming to Claudia's team, because if you wait too long, then it's not going to, your plan could severely be changed, right? The amount of capital you could have to go in and reinvest in those 4 properties might be limited if you call Claudia the day of closing or the day after closing instead of buying those 4 properties, because you have to pay the tax on it. We might analyze your plan and it might only be 2 properties that you could buy in Jacksonville. So as soon as you have that property, or really as soon as you're thinking about putting that property up for sale in whatever market you may be in, that's the time to reach out to Claudia's team. And definitely if you're under contract, that is like beeline straight for somebody in Claudia's role.
Especially now, I don't know if you guys noticed this, the closings are happening so quickly, right? I mean, a lot of these are cash offers. And so you definitely want to reach out as soon as possible. Yeah.
Got it. All right. Well, we got 8 open questions here. I think some of it, we've touched on a lot of this stuff, but let's answer it directly, right? So that our Not Your Average Investor Show community here gets direct value. So John Tennyson asks, he says it's too late for him this year to use the 1031 exchange. However, he has a question. Wouldn't it be better to pay long-term capital gains tax this year before the changes to the capital gains tax rates go up next year? Do you have any insight on that, Claudia?
Yeah, we don't have a crystal ball. I think no matter what happens, I always say to exchangers or someone that I'm talking to initially, whether they're deciding to do an exchange, you always want to make sure that what you're doing makes sense for you, right? That you're not just doing an exchange to defer taxes. There's got to be, most of our exchangers, and I think Greg would say the same thing, is that they're looking to keep the money and also stay in real estate, maybe leave the property later on to their estate. And, by having that, they're creating that wealth and return on investment. But yes, I mean, you have that analysis, right, of whether or not should I pay the tax now or later. But a lot of our exchangers plan on never paying the tax, quite frankly, because you see, they are going to stay in real estate. Some of their portfolio is always going to be in real estate, and they're going to 1031 exchange along. And because the like kind, right, what you sell and what you buy is so broad, what type of property you can buy, there's always some type of real estate to get into. So it's really a long-term play. And, a lot of them are like, look, I'm going to keep doing 1031 exchanges, and then I'm going to leave the property to my heirs. And then the taxes would go away, right? Because of that step up in the basis. So yeah, of course it's a personal decision, but yeah.
I mean, I would say the chances of somebody doing a 1031 today, not paying that 20% or whatever capital gains, and then selling that property in a year from now and not doing a 1031, I would imagine that almost never happens, right? Yeah. It's like when you do the 1031, it's such a core part of your strategy. You typically enjoy the fruits of that. And then you're probably going to hold on to that next property for a period of years. And when you get to that position where you want to sell that next one, you're giving Claudia's team a call back and That's you're right. doing the 1031 the next phase.
Right.
But I think the 1031, we talk a lot about the tax savings component from depreciation of the asset. That helps you defer taxes on rental income that's coming in, right? That's the tax savings component. You see it in our property evaluations. We talk at length about it. I love that. Well, this 1031 exchange is the deferral option for the capital gain part of the equation in real estate, right? So when you can combine depreciation as well as an effective 1031 tax strategy, and there's no limit to the amount of these that you can do, it really, I think, makes what the tax rate, factor into the equation, and almost makes it a moot point, because if you build this effectively, you won't pay taxes, and you may never pay taxes if it actually
Right.
ends up going to your heirs.
And I think also the part of what we're seeing today, and this is really where you guys come into play, so many of our exchangers, it's difficult to find replacement properties. And, the market's tight, and it's really good and our timelines, which I'm sure we're pretty much familiar with, but they're short, right? That 45-day identification period. So you really want to get ahead of the game there. If you know you're selling your property and maybe your closing's in a couple of weeks, or even before that, work with someone like you guys to get that property lined up. A lot of times when we work with JWB, I see that, and this is perfect, the exchange is never at risk, right? Because they're going to sell. And then within that 45-day period, the exchanger is buying replacement property, right? Because it's all ready to go. So that's really important, because we have a lot of exchanges that do sometimes fail, right? Because of that 45-day rule, not finding.
Yeah. We live in our own little bubble here at JWB. And we don't even talk about the challenges that, let's call, normal real estate investors would face with executing a 1031, right? Half the battle is working with somebody like Claudia's team to make sure that you don't screw it up, that you set it up correctly, and her team helps you do that. And then the other half of the battle is on the investor to go out there and identify replacement properties, and then to actually close on those replacement properties. And Claudia, we haven't talked a whole lot about 1031 exchanges. So would you be so kind as to just share what that 45-day rule is, and what the 180-day rule is, just for newer investors?
Yeah, sure. So in an exchange, they want you kind of moving pretty quickly. So look, there's these timelines that start at the closing of the sale property. So you have settlement, right? If that's today, meaning closing, and in different areas, we call it different things, like close of escrow, but that's when the property conveys, right? Benefits and burdens passed. That is the day zero of the timeline. So we have 45 calendar days from the closing to identify what we're going to purchase, and 180 days to close on the property. So those timelines run concurrently. So when we get to day 45, we only have 135 days left. Now, the one that's going to give us the most problem is the 45-day rule, right? Because what happens is, once you get beyond day 45, you cannot change what you identified. So we get past that time period, and now if anything happens to the properties we identified, we're out of luck. Here's the other issue. We can't just take the MLS listing, right, in a particular area and say, okay, it's going to be one of these properties. We have to pick one of these identification rules. And the one that's used most often is the 3-property rule. So you can identify any 3 properties regardless of value. Now, what if we are doing the example Greg had, where maybe we're selling in California and now we're going to go out and buy 4 single-family homes as replacement property? Well, we can't use that 3-property rule, right? So we got to go to this 200% rule, which basically states, well, identify as many properties as you want. However, the total value of what you identify can't be more than double of what you sold for. We sold for $1 million, right? I can identify 5 properties, can't use the 3-property rule, right? As long as those 5 properties don't add up to 2 million. So when we're doing a diversification strategy where we're selling one larger property and going down into smaller properties, the 200% rule works really great. But I find a lot of people get that confused. They think, wait, it's the 3 and the 200%, right? But it's not, it's either or. And if they were going to come in and buy a portfolio of properties, and let's say the 3-property rule doesn't work, the 200% rule doesn't work because I've identified 5 and it's over 2 million, there's this 95% exception, which basically is saying just buy them all. So if you had someone that wanted to buy, or if you guys wanted to buy a portfolio of properties and you're going to buy them all, you can do that as well. So again, it's the 45-day. We got to get ahead of that. because that is really challenging. All right. Even if you get an inspection, you get past 45 days and there's an inspection or the seller backs out, that none of those are going to give you any kind of extension there. The only extension that's out there is a or I should say federally declared disaster. So like Ida, right? The latest hurricane that came in, that would be an example of it, or the floods, or we have a lot lately, unfortunately, or the fires, right? But hopefully that doesn't happen, right?
Yeah.
So we're stuck with the 45 and the 180-day deadline.
Question for you. Do you have to identify which of those strategies you're choosing right off the bat, or can you go with the 3 and then if it turns into the 200% rule, could you do that?
Yeah, you don't have to identify which rule you're going to use. You just have to fall into one of them, right? So we provide an identification statement to our exchangers. Once the funds come over to us, we set up a segregated separate account. We send them confirmation of the funds, and then we send an ID notice. So it's very clear on that. It just depends on what you start doing. If you have 3, we don't need the value. If you go over it, then we want to see what the values are. So it doesn't go above the 200% rule on that.
Makes sense. And in a normal real estate world, choosing with confidence 3 properties that you're going to be able to close on within 45 days is like impossible in a normal real estate world, right? We talk about the differences between a turnkey experience and investing in a normal real estate experience. And it takes sometimes 9 to 12 months to be able to close on your first investment property if you're doing it the old way, right? Not the turnkey way, right? So this is some coordinated stuff you have to have down just to be able to find properties in the normal world. Now factor on what we talk about often here on our real estate market updates, the fact that we have 1 month of inventory in Jacksonville, which is incredibly low. There is just very limited supply, and that makes it even harder, right? I mean, I could think of scenarios where folks are lucky enough, and this is not with JWE, but just in the regular world, lucky enough to identify 3 properties. They go down that path, and then, there is something that comes up that, they identify the property, the seller, gets back to them 2 weeks later and rejects the offer. And now they're starting over, or they go down that path, they get all the way to the, a home inspection, and it comes back and that blows up the deal. And then all of their 1031 tax deferral strategy could be lost there. So it's really hard if you're not going down a turnkey route just to be able to meet the commitments. The wonderful thing is it's with turnkey, it should be easier. Now, most turnkey providers right now are facing the supply level challenges as well. So they put you on waiting lists, which is a hard thing to overcome if you're doing a 1031. Of course, for all of our friends here on the show, that JWB has inventory. This is something that we can execute all day, every day for our clients right now. We're really one of the only outfits in the country that can handle 1031s right now because we actually have inventory and because of such tight timelines. So it's something to be aware of. And of course, if you're a JWB client, it's something that we got your back. It's easy for us, but not so in the normal world.
That's good to know, because there was some questions already asking if JWB is able to execute on this stuff. So good to know that you can. Also, real quick clarification, 45 days to identify a property, 180 days to close on it. Is that
correct? Yep.
And that's from the moment that you sell your property? Okay.
Not the contracts, right? It's the closing.
Okay.
And one other thing to keep in mind too, it's again about the contracts. If you can enter into a contract for the purchase, right? Let's say you find something at JWB before the relinquished property closes. You just want to make sure that the replacement property closes after the sale, right? But that's not a bad way to go. I mean, it's a great way to go, just after what Greg is saying, that we have the sale. A lot of times, when they work with JWB, we have the sale contract and the purchase contract, right? All wrapped up. Yeah.
Got it. All right. So we have 13 questions in the Q&A, tons of curious investors in here. So let's see if we can knock all these out as quickly as possible, because Greg likes to talk, just for the record. All right, here we go. Sarah Jennings has a question. If you do a 1031 and reinvest in 5 more properties, what happens for taxes if you sold those 5 properties in 10 years and wanted to cash out? How do the taxes work then?
Sure. Yeah. And actually, that's a nice example of like, if you sold, we'll just go back to the $1 million. Let's say we sold for $1 million, we bought five $200,000 properties. If you sold that one property, then you're getting hit in one tax year, right? So let's say the strategy is we sell the one, we buy five properties at $200,000 each, right? Now, how it works is that when the tax basis, right? And just as a simple overview, tax basis is what we pay for the property plus capital improvements minus any depreciation. One of the things in a 1031 exchange is, being a deferral strategy, the tax basis in the sale property moves over into the replacement properties, right? So let's say on the $1 million sale, we bought that property for 500,000. It's now worth $1 million. So we have a $500,000 basis. You're going to see I keep the math really simple. This is for my sake. So I went to law school. So we sold for $1 million. We had a $500,000 basis. And now we go out and we buy five replacement properties. So what happens is the basis is allocated proportionally amongst the five properties. So now we have the properties are 200,000 and we have a $100,000 basis in each. So when we go to sell, what's nice is if that strategy of diversifying, we can pick and choose when we want to sell each one. So now instead of selling a $1 million property in the 1 year, we can then, as we get older or whatever, we can start selling those properties. But what happens to the deferral? It's proportionally in there. So if I sell one of those properties, and now I did really well, it's not 200,000, it's 300,000. So I sell for 300,000, my basis is 100. Now, of course, that moves up and down. That's why it's just right for capital improvements and depreciation. But that's how it works. So that you could really, that's a good question, because you could really just take that one and spread it out and then over time sell them.
It's really cool. I never really thought about the flexibility of choosing when you're going to repay the taxes.
Yeah.
Right? That's pretty cool. 1 to 5, you have more flexibility. And of course you have the choice to continue to do 1031s and then not pay the taxes on those 5 in perpetuity.
Interesting. All right. Lee Bishop asks, does IPX Exchange charge a percentage to quarterback the deals?
No percentage. We do all types of exchanges. The one we're talking today about is the regular exchange that's most common, or a delayed exchange. You sell, money comes to the funds go back out for purchase. On those type of transactions, it's a flat fee. We do also, by the way, do these reverse exchanges, right? Where if you have a situation where you absolutely have to buy the replacement property first and sell, those kind of work on a percentage of different factors of the amount of the value of the property we're going on title to, because we got to park it until the relinquished property sells, and also the value. But the forward or delayed exchange, the one we're doing 80% of the time, it's just a flat fee. And it's somewhere around like $1,200 for one sale, one purchase. One of the things that we offer is, being a Fidelity owned, or our parent company is Fidelity, meaning not the Fidelity Investments, Fidelity National Financial, the underwriter for real estate, for title insurance. But we're able to give the highest level of bonding and insurance in the industry as well. But we walk you through the whole process, and we also put all the funds in like a segregated, separate account.
Sounds like money well spent. All right. Tara Paget asks, so if you sell an asset, then reinvest in another property within 6 months, are you allowed to hold funds and reinvest, or do you always need to use an intermediary upfront?
You need to have an intermediary. And what's so critical about the qualified intermediary is, if you don't have the intermediary, you have a sale and a purchase. There's many sales and purchases, right? What connects them together? So the qualified intermediary is creating that exchange. There's two really important documents. We have several in our packet, but one is the exchange agreement. And the exchange agreement is between the exchanger, right? Or anyone that's doing the selling the property, and us. And that creates that nexus between the sale and the purchase. And then also what we're doing at the settlement, technically, is we're stepping in the shoes of our seller. One of the documents that we are creating is what's called the assignment of either the relinquished property on the sale side, or the assignment of the replacement property. Other really important part of it is, you can't receive the funds if you want to do an exchange, right? If you receive the funds, well, you got to pay the tax. So the funds would come over. So what's going to happen? You're going to close that property, or you're going to go to escrow on that property like any other sale. But once everything is completed, real estate commissions are paid, closing costs are paid, mortgage is paid off, the net proceeds will come over to IPX. And then we send those funds over into the replacement property. 1031 is not an all or nothing proposition. We have a lot of our exchangers that have a lot of gain in the property and they want to take some money out. They want to pay some tax, defer some tax. Not a problem, right? They can do that. So just keep that in mind. You know, if you have a $1 million sale and our basis now is 100,000, so all 900,000 is taxable. Well, I may decide, you know what? I'm going to buy replacement property of 500,000 and I'll pay tax on the 4, right? So that's fine, right? One of the things I do, well, maybe we should get through the questions and then I'll see if maybe someone asked
Yeah, it might happen. It might happen. So, listen, it sounds like as we keep going, there's more and more flexibility, more and more reason to, use your expertise, right? Hop on a call with 1031, hop on a call with your advisors, right? With IPX, Claudia. And I know somebody earlier, I think it was Danette, was asking, how do we get a hold of you real quick? What is there an easy way to get a hold of you that we can just kind of share right now as people are kind of writing this stuff down?
Absolutely. So there's a toll-free line. It's 877-494-1031.
Easy peasy.
Yeah, 877-494-1031. Also, our website has got a lot of great information on it. It's ipx1031.com. That's I is investment, P is in property, X is in X-ray, 1031.com. If you go on there, there's webinars, there's capital gains estimators. If you go into Experts Nationwide, get on that, you'll find me and my team there. So that also will give you all my direct dials and all.
Excellent. Excellent. So we shared that in the chat, 877-494-1031, IPX1031.com. Also chatwithjwb.com. If you have, if you were looking to do this and you want to start identifying that process, like Claudia said, that you want to kind of already have that property in mind before you're going too far down the process. And all right. So Denny Davies has an interesting question here. Claudia or Greg, do you have a personal experience where your attempt at a 1031 went sideways?
I don't. I've gone through Claudia.
Me too. I mean, well, we have exchanges that just, for the reasons we've mentioned earlier, that like, for example, we had one where it's the 45th day, right? So one of my coordinators calls the exchanger up and says, this is your 45th day. I received your identification, but there's only one property listed on there, right? And so she said, don't you want to identify any other properties just in case something happens to this property? And the exchanger replies back, oh, no, just this one. This is the perfect property. Nothing can go wrong, right? And that's when my coordinator, who's been in the title industry for many, many years, like the hair stood up on the back of her neck, right?
Yeah.
And so what happened? It fell apart. Actually, what happened in that particular situation, the seller backed out because they had a buyer that would pay more for the property, right? So that was unfortunate. So there's trying to think of any other kind of, that's the biggest one, is the 45th day. The other is, again, not having it set up beforehand, right? One of the other ones too, that we talk about, that's a misconception out there. A lot of times people think that they only have to reinvest the gain, right? 1031 to be fully deferred, you got to buy for equal or greater value to what you sold for minus closing costs. So it's the tax basis that's moving over and the gain. So some of the things that I see happen is that, okay, they start buying their replacement properties and now they don't have enough, right? They're not up, so they'll have what we call boot, which is fine. Whatever the difference is between the $1 million and let's say the 800,000 that they purchase is going to be taxable. So you definitely, that's one thing that kind of comes up where something might have fallen out or they don't have, enough properties identified. But again, the sooner, if you do things quicker, it will help tremendously if you have it all up.
And never say nothing could go wrong. I think that's,
I know.
we all know Murphy's Law there. Real quick, Lee Bishop asked, if we go through that 877 or IPX, do they ask for you as a JWB client or is kind of anybody there? Is gonna be? All right, there you go, Lee. Great question. All right, so KP Rajan has a follow-up. If we tax defer now through 1031, payable at some point in time in the future. Oh, wait, is the tax we defer now through 1031 payable at some point in the future? which is a yes, right? Like you later on you will pay it, and we
You
talked about
sell
different.
and don't do an exchange. Yes.
I'm sorry. Yeah. Okay. If yes, what would that be at the rates I would have paid today or at the capital gains rates? I think I feel, I don't know. Do you know how to answer that? I'm not really sure.
I think he's
Yeah.
asking what tax rate would you be taxed at? It really would depend, like the other
That's
question.
what it sounds like to me. Yeah.
I think he was asking, is he going to be taxed at the rates that he didn't pay today, or is he going to be taxed at what the capital gains rates would be in 10 years when he sold? And it would be whatever the capital gains rates are in 10 years when you sold, or whatever time frame you had. That's potentially what your tax would be. And then, of course, at that point, you would have that same decision to be able to do another 1031 and not pay the taxes then and defer that again if you so choose.
Okay. And what are the cap gains rates today? Is that a standard number, or is that a variable depending on where your income is?
It's a variable. It just increase, but it's 15 or 20% depending on your taxable income. I think for a married couple, it's just over 500,000, and a single filer is high 4. So if you get above the thresholds, then we're looking at a 20% rate.
Plus like you mentioned earlier, Claudia, like the
The 3.8% funds the Affordable Care Act. So if you have investment income that's over this threshold, much lower, 200,000 for a single filer or 250 for a married couple, then you're going to get that additional 3.8% tax. So it adds up. And then depreciation that you've taken on the property, we call this the hidden tax, because most people don't know, that when they sell the property, it's recaptured if they don't do an exchange. Like sometimes I'll get a call from someone and they'll say, I don't think I need a 1031 because I'm not really selling it for much more than what I bought it for. And then I'll ask, well, how long have you owned it?
Mm-hmm.
Yeah.
Yeah.
The tax advisor is depreciating it. So that lowers that basis down. And that's at a rate of 25%. So it's significant. And then, as we all know, most people have it's 41 of the 50 states have some state tax as well. Right. So where I'm from in New York, it's pretty high. I think it's like 8.9. I think New Jersey now is over 10. So yeah.
Not Florida. That's why we all live in Florida, right?
That's why everybody's moving to Florida, at least the cool kids. All right. So I'm going to handpick a couple questions here, right? Sometimes we have people join us from France. Claudia, we have somebody today, Anonymous Attendé, is asking if your property is in a trust, does this alter the exchange in any way?
No, I mean, all properties owned in many different types, right? As a single person's husband and wife trust, land trusts, revocable trusts, S corps, LLCs, whatever they are, they can do a 1031 exchange, right? The issue though is it's got to be the same taxpayer moving forward into the replacement property, right? So if I'm selling in Jacksonville Investments, for example, and the three of us, right, Pablo, Greg, and myself are the three members, that's a partnership. We kind of need to go out and acquire our property the same way. So it's got to be the same taxpayer. But a lot of times these trusts, they're what we call disregarded entities. They don't exist for federal tax purposes. So there could be some flexibility there with that.
Got it. All right. Zach Correa asks, what exactly does it mean to identify a property? Like what is that exact definition?
Yeah. So what the Internal Revenue requires is that the exchanger identifies to someone that's not disqualified. So qualified intermediary, possibly the seller of the replacement property, but it's got to be site specific, meaning if they're looking to buy a condo in a large building, they can't just put the address of the development, right? They got to put the unit number on there. So it's got to be in writing. It's got to be received by that non-disqualified by midnight of the 45th day. So they have to be site specific. So if they're also identifying land, they can't just put 22 acres in a certain county, right? They have to put the legal description. So we want to be site specific. Within the 45 days, you can revoke and re-identify, but once you get beyond the 45th day, you cannot.
All right, good stuff. Saren Jennings has an interesting question. Can you do a 1031 exchange and buy a property to use as a short-term rental like an Airbnb?
Yeah, absolutely. That is one of the things we've seen an uptick on since coronavirus, where you see some long-term property owners going into short-term rentals and in warmer climates near the beach. Or, yeah.
Great. All right. We're going to just pick one last question here. Drew Barnhill asks, is there ever a right time to do a 1031 exchange with a personal property since you have the one-time exclusion?
So one of the things, when we look at what qualifies for 1031, it's property held for investment or business use. When we're selling a primary, that's not considered, even if it's our biggest investment, it's not an investment property in the eyes of the IRS, right? It's a personal use property. So if the last use is personal use, like pure second home or primary residence, you can't do a 1031. But it's the primary residence exclusion is quite generous. It states that as long as you live in the property 2 out of the past 5 years, all gain up to $250 for a single filer is exempt from tax, and a married couple 500,000. It's no longer a one-time thing. I mean, you can only live in one property during that time period. But yeah, you wouldn't be able to do an exchange with a primary. Now, here's the thing. You could have been your primary many years ago, and then maybe the last use was rental. That works, or vice versa, the other way around. So.
All right. These are such great questions that I keep finding. 2 really quick hitters, real quick. All right. Roger Evans asked, is there any extra tax burden by not meeting the deadline? Are you just on the hook for the taxes that you would have paid, or is there an extra thing if you fail?
No, I mean, we have sometimes, we get calls here, like the last minute exchange, especially, right? Someone's going, oh my God, I just found out about an exchange. I got to set it up. I don't know if I'm going to find something, but if I close tomorrow, I lose my opportunity to do the exchange. So you could start an exchange, and what's going to happen is if at day 46, there's no identification, the exchange automatically terminates. We're returning the funds to our exchanger. There's no penalty. I mean, we do have our exchange fee, but there's nothing wrong with trying to do an exchange and not being successful.
Awesome. And then last one, I promise. Sergio Prieto asks, if I inherited a property from my parents, the house is under parents' name, and the proceeds earnings from that property are split between my brother and I, and my intent is to use that portion of those earnings towards real estate, does that scenario qualify for 1031?
So a couple things. It really depends. So when they inherited the property, when we inherit property, and if we inherited it recently, a lot of times we don't have a gain because we get a step up in the tax basis, right? Now, depending on how they own that property, this is what's important, it's key. Once they inherit that property, they would want to make sure they're on title to the property as tenants in common, right? So that each brother owns 50%. And so then when they go to sell, they can take their 50% of the sales proceeds and do an exchange.
Okay. All right. Good stuff. Great nuanced questions. I got a couple here on the board. Unfortunately, we're right up on time. Claudia, this has been super, super interesting. We've had 30 plus people here the entire time. It's so great to have the community here hanging out with us. It's a testament to the value that you're putting out. Amazing, amazing questions from everybody today. Join us on Thursday where we do our JWB Rental Income Property of the Week. And we do the same exact thing, just with a property, right? Like we go question by question, answering questions the same exact way, analyzing a deal. We'd love to see you bring a deal from someone else, right? Like GC has thrown up the bat signal. If you're analyzing some other deal, you got some Excel sheet that somebody gave you, we would love to give you the questions that you're supposed to ask, or ask the right questions and see how it compares, analyze it for you, right? Let's look at other deals that aren't just JWB. Bring it from another market, something else you're looking at. We'd love to make that happen. Again, hope you got the value out of this 1031 exchange. This is all about owning rental income properties, property management, the real estate market here in Jacksonville. Next place to go to chatwithjwb.com. If you're thinking about doing something like this, if you want to identify a property, hope to have you here in between us. Claudia, this has been awesome for me to learn. I will give GC the last words here.
Just want to say thank you to the community for being here, making this super special each and every Tuesday and Thursday. Looking forward to seeing you all on the show on Thursday, where we get to evaluate properties. And if you're thinking of a 1031 and you've got that 45-day window, well, guess what? Show up on Thursday for the property of the week, and you'll have that 45-day window knocked out day one on Thursday there. So super excited to have you all here going forward. Claudia, it's been amazing to hang out with you again. I mean, I just continually am impressed with your knowledge and how you take care of our clients. I just so appreciate the professionalism that you bring, and you just being an incredible resource for our community here. So let's not let it go so long before we hang out again. Okay, Claudia?
Absolutely. Yeah. We'll get together soon.
All right. Thank you, everybody. We'll catch you on the next one.